We're back, everybody. Welcome to our YouTube channel. You know us. Who are we? The Dividend Diplomats, everybody. So what are we going to do today? We're going to talk to you about an undervalued dividend stock. But you know what? This isn't a stock we've been asking about. It's been a stock that has continued to pop up in our comment section after our comment section. And when you start looking at the metrics, it was pretty interesting. And oh yeah, by the way, their yield is over 3.5%, everybody.
Ooh, yeah, but guys, smash that subscribe button. Give Bert and I a nice thumbs up. We're the diplomats, baby. You're either riding with us or you're against us. Bert's got a great stock here. He loves this industry. And I'm like, Bert's salivating right now, trying to dig into this dividend stock.
I don't know if salivating is the right way to say it, but compared to others in the sector, especially because we own companies in this sector, it's a sector we talked about for a while. We've just never really covered this stock. We have to at least do a video on this company. Lanny, what company are we going to talk about today?
We are talking about none other than, you guys guessed it, but probably not. We're talking Comcast, ticker symbol CMCSA. This stock is getting crushed over 40% this year, Bert.
I know it is not a good year for the sector. I mean, think about the two industries that they operate in. Internet companies. Hey, look at your Verizon investment. Look at your AT&T investment. Look at how great that's doing. I'll give you a hint if you're not sure. It's not doing great. It's probably down a little bit this year if you haven't checked in on that one. All the other sector between their owning of NBC and their other content is in the streaming. They have the Peacock streaming. They have all of that great stuff. And Lanny, how is the streaming sector doing this year?
The war on streaming is real. The pandemic has died down, so people may be jumping ship with how many streaming providers they have. You name it. You've got Peacock, Netflix, Amazon, Apple Points, Disney TV, or whatever it's called.
Paramount.
Disney Plus. Paramount.
Yeah. Oh yeah. Did you mention Hulu? Yeah,
I
Hulu.
think I did.
I don't know. Who even knows anymore? That's exactly right. Yeah, ESPN Plus, ESPN minus.
Who knows?
Yeah, you're rebundling. You're going snip, snap, just going through there.
Michael Scott, baby.
Yeah. Hey, Comcast, Michael Scott. But in all seriousness, we figured it'd be good to check out the one that we haven't really covered on here. So let's pour into their financials. They last reported earnings at the end of July for the second quarter, for the first 6 months too. So this is going to be ahead of their earnings release at the end of October. You know what really jumped out to me when you first look at the income statement here for Comcast, Lanny?
What jumped out on the page for you?
How much revenue and free cash flow this company pumps in year to date. 61 billion in revenue, up 9.5%. Free cash flow, 7.9
free cash
billion.
flow, baby.
Yeah, free freaking cash flow. Adjusted EBITDA, almost 19 billion. So I mean, they generate a lot of money. That's not the issue here with Comcast. Top line, bottom line, free cash flow. All their free cash flow is dropping down. It's down 21% compared to last year over the same 6 months.
Now the big concern is how much debt Comcast has on the balance sheet. So guys, we're in this recession right now. You need companies that are liquid, that are agile. When you're battling in streaming wars, usually that's a lot of capital that you're putting to work. So you really want to look at the balance sheet here. And Comcast doesn't have the worst balance sheet, but they don't have the best balance sheet. Go ahead, Bernie.
No, I was just laughing at this statement. Not great. Okay. Not great though.
Yeah. Sustainable? I think so.
Yeah.
But, we look at the quick and current ratio, which is how fast they can pay current obligations. It's not even 1x, which we usually see 1x, at least on the current ratio, but not in this case, which is current assets, current liabilities. It's 0.9. And Bert, they're straddled with about $100 billion worth of debt, long-term debt, that is.
I know. And what's funny is you look at the debt to equity ratio and you're like, it's not bad. It's 1.08. And then you see the actual dollar amount. And you're like, ooh, $91 billion in debt.
So when rates are rising, dollars cost a little bit more. If they have anything that's maturing, they have to get new debt, or if there's any sort of adjustable rate function within their debt.
Yeah, the management team's like, we got that $91 billion at a low interest rate now, didn't we?
That's right. There it is.
Yeah.
But
Yeah.
guys, but that's not all we're looking at here for Comcast, because Bert, we got to run them through a certain model. What model are we about to push them through?
We're about to push them through the Dividend Diplomat Dividend Stock Screener that focuses on 3 simple metrics here. You got
Man,
the price to earnings ratio less than the S&P 500. Got that payout ratio less than 60%. Let's turn this one up the right way. Then last, you have that dividend growth history.
joke, man.
Yeah, it wasn't the bad one here. Then the
First
bonus
column.
yield. Let's see. Oh, let's see. Where was it? Where was it? That bonus yield, which should be the rare, which was this one. Whoever this card is. But the yield on Comcast is a little bit better than Cramorant. But all right, in all seriousness, everybody, we're talking to you about Comcast close price as of Thursday, October 6th, 2022. So we're getting a little head start on recording this video before the market at the end of the week. Let's jump into that first metric. Comcast closing price, $30.05, just above 30 cents. EPS, 3.59. That is a PE ratio of 8.37.
Seen that before with AT&T and Verizon. Low price to earnings ratios because the future does not look that strong right now. Granted, that's a low PE ratio, lower than the market, not lower than the competition. But let's look at how safe that dividend payout ratio is. Could this be one of the safer dividend payouts of the telecommunication slash, content kings here? So looking at a dividend payout ratio, looking at 40 to 60% here, guys, they are actually below 40%. They pay $1.08 with earnings expectations of $3.59. You take the $1.08, divide it by the $3.59, and guess what? You got 30% payout ratio. So they only pay out 30% of their earnings, plenty of room to keep you in bed at night instead of up, and increasing it going forward.
So the third metric, 5-year dividend growth rate is 11.69%. They've increased that dividend for 13 consecutive years, so not a bad streak here. Although probably wouldn't expect a 13% dividend increase in the short term. I think that's probably in the past. You're going to see probably more in the low to mid single digit percent for Comcast.
Have to find out, guys. Now that yield is 3.59%. To get the yield, you take that dividend $1.08 divided by $30.05. So in summary, you got an 8 PE, a 30% payout ratio, a significantly high dividend growth rate, albeit we think that it's going to be a lot lower than 11%, maybe in the 5 to 8% range, with an above average dividend yield that's more than 2 times the S&P 500.
So what are the thoughts on Comcast here? Because it's interesting, because you called it out right there, Lanny, when we were talking about the PE ratio. You have they're like a hybrid between 2 different sets of comparable companies, right? You have your internet companies that are AT&T and Verizon over here. Comcast has internet, but they're missing out on the wireless part of it. That's not part of it. Then you have your Paramounts over here that are just the content. So Comcast is somewhere in the middle. They're doing the thing. It's like, where all the question marks are coming around on the screen. They're trying to figure out how to make it work. But with that being said, they're obviously treating this compared to the market and to a lot of the other companies. What's key to me is the payout ratio. Why I feel better about them than I do about like an AT&T or Verizon with this higher debt load is because that payout ratio is only 30%. Like you said, when you called it out there with the payout ratio, plenty of room to keep that dividend safe as it is. That's plenty of room. Earnings cut in half, you still have a strong payout ratio. And I think that's key to focus on when you're evaluating a company like Comcast.
It's key. Now, Bert, you own AT&T, you own Verizon, you own Paramount, don't you?
I do. Yeah.
Yeah,
I'm excited about that one. But the question is, am I buying Comcast? The moment? No. I'm good on the sector for the moment. I think I've tapped out on this sector. I have enough of an allocation between those companies. So I'm cool. But if somebody doesn't have a play in here, I could see based on the metric why somebody would look at a company like Comcast and say, this is going to be my entrance into the internet sector. What about you, Landy? What are you thinking?
I own a lot of Paramount. I own a lot of AT&T. I own a lot of Verizon. I'm playing it cool. And I also own Warner, Media.
Oh, yeah. How could we forget about them?
Yeah. So let's not forget about that other streaming network that if we forgot about them, That can't be a good sign. But guys, what are you doing? Are you buying Comcast stock? You think this is a great stock to buy now to really juice up that dividend income, that passive income stream? Because we're all on this journey to financial freedom. So we want to know if you guys like this stock. The metrics do look great.
Yes. So everyone, if you haven't already subscribed to the channel, give us that thumbs up. Almost at 15K. Thanks, everybody. You know what, Lanny? I think it's time. Send us out of here.
That was Bertha Hurt and Lanny from the Dividend Diplomats, over and out.